Hello, Brian Weeks here again with another MMCD contract consideration. This short video clip will cover the topic of unbalanced bids. The topic of unbalanced bids seems to be one where there is little consensus on both the definition and how to evaluate whether a bid is indeed unbalanced. As my experience is as a contractor, I've never been in the position of having to determine if a bid was unbalanced, and if it was, whether it was so detrimental that it should be discarded. To research this topic, I spoke with a construction lawyer, a couple of consultants, and a contractor. As the MMCD instructions to tenderers makes no mention of unbalanced bids, I also went to Google University to see how other jurisdictions deal with this topic. As I'll show in a later slide, there is some consensus on when a bid is so unbalanced that it must be discarded or have payment schedule adjustments made by the owner. But there is little to no assistance on objective tests to apply in making that determination. What I'm trying to say is that if you are watching this video to get a formula or process, you will not find it here. I will give you some help with definitions and to explain the limited protection in the standard MMCD general conditions, which provide some help in this regard. First, some definitions. There are two types of bid unbalancing that a bidder's estimator might use. The first is what I call cash flow unbalancing. The purpose of this strategy is to front-end load the costs. This is done by reallocating costs and profits from tasks occurring later in the project to those which occur at or near the start. By doing so, the contractor will get the benefit of payment for work not yet done and have their profits in the bank sooner than warranted. The second type is what I call opportunistic unbalancing. This type of unbalancing can only be effective if the estimator believes the owner's listed quantity on the schedule of quantities and prices is significantly understated. The understatement may be due to typographical errors in the preparation of the schedule, or it may be due to the bidder having better knowledge or expectation of the condition for that scheduled item. The way this works is that the estimator will put an excessive unit price on that item, hoping that the quantity overrun he expects will provide a windfall gain. Either type of unbalancing is detrimental to the owner's interests and benefits the contractor. In the case of cash flow unbalancing, the owner would be paying for work not yet performed and profits not yet earned. This increases the owner's risk if the contractor were to go bankrupt, and also provides motivation for an unscrupulous contractor to default on completing the project if the remaining revenue will not cover the remaining costs. In the case of opportunistic unbalancing, the contractor is hoping to take advantage of a mistake or an imbalance of knowledge to make a windfall gain. This might be classified as unjust enrichment. It is certainly contrary to the MMCD's basic philosophy of fairness and not taking advantage of the other party. Let's look at a simple example of cash flow unbalancing. In this fictitious scenario, one of the early work items is clearing and grubbing of the site. Much later in the project schedule, there's a requirement for landscaping. A realistic lump sum for the clearing work is $100,000, to which the estimator adds 20% for overhead and profit. Similarly, the realistic cost of the landscaping is $50,000, again with a 20% markup added. These two items total $180,000 as shown. A bidder who wants to front-end load this tender deducts $50,000 from the landscaping item and adds it to the clearing item as the tender pricing is being finalized. Because this is a simple transfer, there is no net change in the value of the bid. The two items still total $180,000. Clearly, there's no increased cost to the owner. However, if this bid were to be accepted as tendered, the owner's risk level would be increased compared to accepting a bid which had not been unbalanced. I mentioned that my research showed me there is some consensus on when an unbalanced bid may be discarded or when it would enable an owner to delay some payments. It is a two-part test. First, the bid must be judged to be mathematically unbalanced. The definition here is that not all items in the schedule of quantities and prices carry their proper share of costs and markups. This matches the scenario I just discussed. Second, the effect of the unbalancing must be judged to be material. That is, the unbalancing is sufficiently extensive that accepting the unbalanced bid puts the owner at risk of paying too much to get the work done compared to accepting another bid. Unfortunately, however, nowhere did I find any simple rules to do either of these evaluations. Different jurisdictions use different criteria and apply different consequences by adding unique items to their instructions to tenderers. So what does an owner who is using the MMCD do to protect itself? Unfortunately, the MMCD does not define or even mention bid unbalancing. In my canvassing of lawyers, consultants, and contractors, the common response was, "I cannot define it, but I know it when I see it." This was not any help as a teaching or learning tool. It is not uncommon for owners to add an item in the instruction to tenderers saying either unbalanced bids will be rejected or unbalanced bids may be rejected. But rarely is unbalanced bid defined, and without some objective measure, neither bidders nor the tender evaluation team truly know what is allowed. Our instructions to tenderers 15.1 says in part, the owner reserves the full right in its sole discretion and according to its own judgment of its best interests to reject any or all tenders or to waive any defect or deficiency in a tender which does not materially affect the tender or the tender price relative to other tenders. This language does not provide unlimited discretion to owners. While there's no question that owners have a right to cancel a tender call for any reason, the ability to waive defects is limited. Although an unbalanced bid could be argued to be a defect which could be overlooked, owners who have said unbalanced bids will be disqualified and yet still wish to accept one should do so only after consulting with a lawyer. If an owner has not stated that unbalanced bids will be rejected but wishes to do so, it will need to set out some objective criteria and clear tests for the evaluation team to apply. Again, getting current legal advice is essential. The obvious test an owner can apply is to compare the line item costs of the suspect bid to all the other bids received. It may also be possible to compare bid prices to other contracts having similar work items, but that is clearly a more difficult comparison. The award evaluation team must act in good faith and carefully document their determinations to have evidence in case of a court challenge. What makes this evaluation subjective is that there may be valid reasons for the differences between bids. Sometimes bidders adjust unit costs to hide pricing strategies from their competitors. Sometimes the differences result simply from different approaches to estimating, and sometimes the differences are due to different work plans or sequence of tasks assigned to different subcontractors. Another thing to keep in mind, particularly with regard to cash flow unbalancing, is that the owner has usually required and paid for a performance bond. This ensures that the owner is protected from additional direct costs should the contractor go bankrupt or abandon the work. This protection does reduce the risk of accepting a bid which is cash flow unbalanced. As a final point here, be aware that it is illegal for an owner to judge a tender to be unbalanced, then require or even request the bidder to rebalance the bid with the same total so the owner can accept the low bid. Once the tender closes, courts are unanimous that no adjustments to the tender are permitted. Let me now move on to opportunistic bid unbalancing using another fictitious example. Assume there's a line item in the schedule of quantities and prices for mass rock encountered in a pipeline trench. The estimated quantity on the schedule is written as 100 cubic meters, but this was actually a typo and should have read 1,000 cubic meters. Let's see what might happen if an astute estimator recognized this was an error. In my scenario, an appropriate price per cubic meter, including markups, is $20. This would make the line item extended cost $2,000. But this bidder assumed the quantity would be far more and increased the unit price to $50 per cubic meter. The line item as bid thus extends to $5,000, or an increase of $3,000 in the total tender price. When the final quantity actually becomes 1,000 cubic meters, the owner would pay $50,000 at the higher rate versus $20,000 at the more appropriate rate. In this example, the contractor would get a $30,000 windfall. For this type of unbalancing, the MMCD already has some built-in protection for the owner in the form of quantity variation adjustments. GC 9.4.3 sub 2 allows either party to request the CA initiate a pricing review when the actual final quantity is below 85% or above 115% of the quantity in the tender schedule. Activation of this GC is not automatic, nor is it at the discretion of the CA. A party has to request the CA to do the review, thus empowering the CA to do it. Pursuant to GC 9.4.4, the contractor must provide the requested documentation. So if an owner has accepted a tender which it suspects may have an inappropriate line item price, the owner must request the CA to do the review once the quantity exceeds 115% of the bid level. GC 9.4.3 sub 2 allows the contractor to attempt negotiation of the revised pricing, but if no agreement is reached, the CA is obligated to resort to the cost-plus algorithms in GC 10. Some time ago, I did another contract consideration video entitled How Quantity Variation Adjustments Benefit Both Parties. To avoid extending this video, please review that one for more details on how the process works. GC 9.4.3 was not designed with this intent, but it clearly can be used to protect owners from opportunistic bid unbalancing, as well as simply excessive bid prices. This GC allows the contractor to keep the excess revenue only up to the 115% level, with fair and reasonable prices for any quantity in excess of that, either negotiated or determined by the CA. In the example I used as a scenario, the contractor would be able to charge $50 per cubic meter for the first 115 cubic meters, but the CA might well limit the value to $20 per cubic meter for the balance. Thus, the contractor's windfall gain would be capped at $30 per cubic meter times 115 cubic meters, or $3,450. A far cry from the $30,000 it would have been without the review. To summarize, although bid unbalancing is a poorly defined concept, it is recognized to benefit contractors at the expense of owners. Two forms of bid unbalancing have been discussed. A, cash flow unbalancing, where revenue is shifted from later tasks to earlier ones. And B, opportunistic unbalancing, where a bidder intends to take advantage of an underestimated bid quantity. 3. If owners wish to decline an unbalanced bid, they must A, give themselves that authority in the instructions to tenderers, and B, do the evaluation on an objective and good faith basis. Predefined protocols and excellent record keeping can insulate against a lawsuit. While the MMCD currently provides no owner protection against cash flow unbalancing, GC 9.4.3 sub 2 protects alert owners against opportunistic unbalancing by capping any windfall gains at 115% of the tender quantity. Another contract consideration, entitled How Quantity Variation Adjustments Benefit Both Parties, provides more information on GC9. I hope that this has helped clarify this contract consideration. Please check our website for further assistance and to see what other topics are presented in this series. Thanks for watching.